Morning, everyone. Thanks, Laura. Lots of good advice there. Can't disagree with anything you said there. So I'm just going to see if I have control of the screen here. There we go. I watched a lot of TV during lockdown. I may get a chance in the coming months to watch some more, who knows? And of that TV, some was good and some was definitely not so good. One that was particularly excellent was Chernobyl. And if you also watched it, I'm sure you'll recognize this picture of the RBMK 1000 nuclear reactor that exploded in 1986. I thought the series was great. Of course, at the center of the story is the flawed reactor construction. But what I found really interesting was the flawed political and power dynamic in the Soviet system. The hierarchy and titles provided an illusion of security that was far from reality. In a system where no one dared accept responsibility for fear of retribution, labels weren't just arbitrary, but dangerous. And we can see the danger of unhelpful labels in all areas of our life. And the investment world isn't immune from this. We can see it in the current challenge on greenwashing. But where I also believe it's relevant is in respect of the debate around growth versus value. Now, thankfully, the repercussions of unhelpful titles and labels are far less severe than in the case of Chernobyl. But nonetheless, I feel there are important questions that we need to ask about why, for many, the labels of growth and value are the starting point when investing for the decade ahead. Now, to our minds, growth versus value is just too simplistic. Neither means anything without any substance. What does matter is ensuring that portfolios are well positioned for the long term, because both growth and value will fail as strategies if they can't find the small number of companies that are required to make a real difference to your returns. So static labels of whether a business's growth or value are unhelpful. And instead, we need to look beyond growth and value and think about old versus new to identify the growing businesses of tomorrow. I want to compare Alphabet with IMCD. Now, for some reason, the picture of Google has left this screen, but there should be a picture of Google on the left and IMCD on the right. So of these two companies, which one's a growth company for the future? Alphabet, the parent company of Google, has been a great growth company in the last decade. But we don't think the prospects for growth are nearly as attractive now, and we've sold out. Whereas IMCD, a Dutch specialty chemical producer and distributor, has got a great organic growth runway ahead of it. It comes down to a judgment about how each company is deploying long-term capital and the opportunity in front of them. So we focus on individual companies and their growth prospects and how sustainable they are. Now, it's inherently challenging to do this. We need the willingness to imagine how the future will play out. We will make mistakes. We may look foolish at times. But not doing this and relying on mean reversion to the past is even more dangerous. The world is changing fast, and we need to make sure that we're making every effort to seek out those companies that are aligned with the future economy. So one of our key beliefs is that companies need to invest if they're to take advantage of their opportunities and grow their earnings over time. Growth requires investment for the future. And one of the reasons why many companies are not attractive growth businesses is because they don't invest. This chart shows the extent to which the average company globally is failing to invest for the future. Now, managements have a choice to make every year about what they do with their earnings. Do they reinvest them in the business for growth, or do they give them back to shareholders? And of course, we understand there's pressure from income investors to pay big dividends. We also know there's big incentives for management to buy back shares. So the chart shows the ratio of growth CapEx to buybacks and dividends for a global universe of equities. Far too many companies leverage the balance sheet and lock in low returns through share buybacks and dividends. As long-term growth investors, we focus on companies that do invest for the future. Companies like Alibaba and Netflix, companies that have an opportunity, have the vision to see how it could happen, and then are willing to invest to make it a reality. Our approach is different. If you're focused in the short term, then CapEx can just be seen as a negative hit to earnings. If your focus is in the long term, then your view of the company's future fully encapsulates the future earnings growth that can flow from that CapEx. And this really matters because when we look at the data and analyze what drives stocks to be in the top returning part of the market over the long term, as this slide shows, it is their ability to grow that determines their share price performance. Now let me explain what we've got here because there's quite a lot of information. The chart on the left-hand side shows that over 5-year rolling periods, the companies with the highest earnings growth are highly correlated with the companies that have had the best share price performance. Looking at the table on the right-hand side, it shows the proportion of stocks within each growth quintile which have above market returns. So 76% of companies in the top quintile of earnings growth beat the market, whereas only 20% in the lowest quintile beat the market. That's why our focus is on companies that have the best prospects for growing their earnings. Now, this sounds really simple, and as a concept, it is, but it isn't easy to do in practice because there is a 24-hour news cycle and lots of noise that accompanies it, highlighting a quarterly earnings miss or how earnings will be affected by the new Omicron variant. We need to be patient and look at least 5 years out and not be too influenced by short-term noise. What the data on this slide show is that over 30 years of data, growing businesses consistently deliver better returns. So it's not just the last decade that's been good for growth. However, the companies that grew the fastest over the last 5 years won't necessarily be the companies that grow the fastest over the next 5 years. This is well illustrated by this chart here, this slide here, which shows how much the managed funds, Baillie Gifford managed funds opportunity set has changed in the last 10 years. What the slide shows is the top 25 equity holdings in the managed fund 10 years ago and then today. Now, we may be long term, but we're certainly not buy and hold forever. Of the current portfolio, 52% was unlisted 10 years ago. Also interesting to note, looking at the top 25 holdings now, the portfolio is a lot more than just Amazon and Tesla, both of which are less than 1% of the portfolio. We are growth investors, but we are agnostic as to where that growth comes from. It doesn't have to be technology. There's been a couple of other noteworthy changes in the last 10 years. Significantly fewer financials in the top 25. And there's been a big reduction in energy holdings and tobacco. 10 years ago, energy was around 12% of the portfolio, and it's now less than 2%. And there are no tobacco companies. These are just not areas where we see significant growth opportunities. But the lineup of companies in the portfolio now is one we're really excited about. And that excitement and optimism about the future is something that typifies how we think about the world. There is so much doom and gloom about, so much focus on the short-term impacts of the next virus variant, and plan B. Now, it's easy for human nature to go think about the negative too much. And we don't want to have blind optimism. We recognize there are lots of challenges facing us, but we see the challenges as an opportunity for companies to come out and help provide the solutions. For example, Moderna with its messenger RNA vaccine technology. Now, you might be wondering what this picture is I've put up on screen. This is a picture of the IBM mainframe 370, launched the year I was born, 1971, in case you were wondering. But even more auspicious than that, it's also the first year of the current technological revolution. According to Carlota Perez, a leading academic in the area of growth and technology, we are undergoing the fifth technological revolution of the last 240 years. The first being the Industrial Revolution, starting in 1771. This current revolution, the age of IT and telecoms, is still only halfway through in terms of its impact on productivity and society. She describes a golden age that follows every rapid burst of technological progress. And she thinks this golden age, which has the biggest impact on society, is still to come. It's when the impact of the new technology starts to spread into every aspect of our lives. And that really resonates with what our analysts are describing in terms of the amount of disruption that is happening in the economy. When I speak to Kirsty Gibson, our US equity manager, she's extremely excited about the disruptive impact of technology on health, but also in lots of other sectors. And she says it's on a scale that we just haven't seen before. So in a world that excels in overdoing pessimism, we remain defiantly optimistic. In some areas, our optimism will be misplaced. We will inevitably get some stock picks wrong. And this slide illustrates this very clearly. What it shows is the absolute return of stocks in the managed fund over the last 10 years, with the top 10 and the bottom 10 picked out and named on the left-hand side. First of all, if you look at the bottom half of the chart, you're probably wondering why on earth I'm showing you this and why on earth we own some of these companies. And there is no doubt they have hurt performance. But it is important to be upfront about our mistakes, because it is inevitable that we will make some. Indeed, if I speak to you again in the future, there is no doubt there'll be a new list of names here. The nature of investing in equities is such that the maximum downside is 100%. You can't get away from that. However, the really important point is that when you invest in equities, the upside is unlimited. And it is this asymmetry between the limited downside and the unlimited upside that is our focus. That's why we always look for the optimistic case in the face of negative news flow. Our holding in Ashtead, the UK listed plant hire business, is a great example. It alone has more than outweighed all of those 10 detractors, all by itself. It's made 30 times the initial investment. And companies like Amazon and Tesla have also made between 11 and 13 times their initial investment. It is also interesting to note that all these great businesses have been through periods of volatility where we've seen them lose money for clients. And that's shown in the box on the right-hand side in green. Companies don't grow in a straight line. Change doesn't happen overnight. And all these companies have experienced periods of volatility. And it's a case for all these top 10 performers that they've actually had periods of weakness where they were down between 20% and nearly 50% in the case of Tesla. So the reality is, if we were concerned about volatility, we would miss out on investing in some of the best businesses in the world. There is always volatility when investing in equities. But if we're willing to be patient and focus on the long-term opportunities, there are some fantastic investment opportunities out there. And that's been central to the success of the managed fund since 1987. Another contributor to the success of the managed fund is that we've kept the philosophy and process simple and consistent since the inception in 1987. We only invest in 3 asset classes: equities, bonds, and cash. Our strategic weight is to have 75% in equities, 20% in fixed income, and 5% in cash. Equities are the main drivers of returns, so that's where the bulk of the portfolio is. Fixed income is there to provide some balance and diversification and returns in its own right. And the cash is there to be used opportunistically. It is a really diversified equity portfolio with no one holding or region dominating. For example, our largest holding at the moment is Shopify at 1.5%. And we split the globe into 4 equally weighted regions: the UK, Europe, North America, and then developed Asia and emerging markets. And our regional equity teams contribute their best ideas in the region. So it really is a whole Baillie Gifford firm effort. Our asset allocation between these asset classes and between equity regions is driven by the bottom-up enthusiasms of the different investors, and it's rarely influenced by top-down macro views. We look for which of our investors has the most buy ideas, and we will look to supply them with cash so that they can go out and buy them. Right now, we see consistent enthusiasm from our equity managers and reduced enthusiasm from our bond managers, partly on the low level of yields and the risks of higher inflation. As a result, our portfolio is tilted away from bonds towards equities. But overall, it's a well-balanced portfolio for long-term outperformance. And that's what we've delivered in over 3 decades of actual investing. The fund has been investing the same way since 1987. The chart shows the performance of the managed fund since inception in green, and the median fund in the 40 to 85% shares sector in blue. £10,000 invested in the managed fund in 1987 would now be worth £265,000, which just shows the power of compounding. One thing that really strikes me when I look at this chart, the managed fund has been through a fair few market crises. And the lesson I take is that markets recover, and you need to not worry too much about what could go wrong, but think instead about which companies could go right. Importantly, the data here is net of fees, and in a world of too high fees, the managed fund continues to have one of the lowest OCFs at only 43 basis points. And that advantage, compounded over many years, has helped us stand out as one of the top 2 performing funds in the sector. Now, the managed fund used to be called Baillie Gifford's best kept secret, but we are trying to get out about and talk about it a bit more. And it is the fund which has the most involvement across all investment teams. You could say it's the best of Baillie Gifford's stock picking in both equities and bonds. Now, thinking back to the lessons from Chernobyl, which I definitely recommend you watch, by the way. For me, it is to ensure we challenge, engage, and question what growth and value really mean, that we don't satisfy ourselves with arbitrary labels, but look beyond them to ask whether a portfolio is genuinely well positioned for the long term. Does it hold companies that are investing for the future and that can provide solutions to the challenges we face in a new age of disruption and technical progress? Thanks very much for listening.